If you think gold failed because it fell during a war, then you are staring at the wrong floor of the building. That is where I want to begin. Not with the chart, not with the anchor on television, not with the childish line that says gold is supposed to go up when the world gets dangerous. So if it went down, the whole thesis must be wrong. Number that is lazy thinking. I want you to picture a building, a tall financial building with two floors that both use the word gold and almost never mean the same thing. Upstairs, there is the trading floor, fast money, paper claims, futures, contracts, leverage, margin calls, dollar strength, rule changes, forced selling, institutional positioning, narratives. Noise downstairs, there is the vault floor bars, custody, central bank, sovereign distrust, insurance repatriation, long duration buyers, balance sheet defense, quiet accumulation, trust. Those are not the same market. They are connected, yes, but they are not the same. And once you understand that, almost everything that looked contradictory over the past months stops being contradictory at all. War broke out in the Middle East, oil surged. The Strait of Hormuz suddenly mattered again in a way the modern world had been trying not to think about. The dollar strengthened, treasury yields remained attractive. Gold got hit hard, paper traders got flushed. At the very same time, serious institutions and slower hands kept behaving as if physical gold had become even more important, not less. That is not confusion. That is two floors of the building speaking at once. The source material is valuable because beneath the performance and promotion, it points to the core split. Gold did not simply break during a crisis, when textbooks said it should rise. What happened was that the paper market upstairs was hit by margin changes, forced liquidation, dollar strength, and urgent selling from actors who needed immediate liquidity, while the vault floor downstairs kept telling a very different story through physical drawdowns, repatriation signals, Chinese institutional demand, and central bank buying. Fe turn 64 file 0 Fe, that is the real line. Not gold versus no gold, paper gold versus vault gold. And the reason this matters is not only because of what happened last month, it matters because most ordinary investors spend their whole lives reading the upstairs floor and never learning what the downstairs floor is trying to tell them. I have spent too much of my life around capital to confuse the visible quote with the full truth of an asset. Markets are often honest, but they are not always complete. Sometimes the screen tells you what the leveraged participants were forced to do. The vault tells you what the serious holders still want to own. Those are different truths. So let me show you the whole building the way I think it should be explained. Not as a conspiracy fairy tale, not as a smooth academic lecture as plumbing, because that is what money is when emotion is stripped away. The first floor is what I call the futures theater. Most people still imagine that the gold price comes from miners selling bars or from jewelers haggling over necklaces or from rich old men stroking coins in velvet boxes. Fine, that is the image. But the price they watch is usually not being set by a man loading a truck with bars. It is being set by paper. The source material says this directly and correctly. The benchmark gold price most people follow is usually the COMEX futures price, and only a small fraction of those futures contracts ever result in physical delivery. Most of them are paper claims, directional bets, leverage positions, and balance sheet instruments, Fe turn 64 file 0 Fe, that matters enormously. Because once price is set in a paper arena, price becomes vulnerable to everything that matters in paper arenas. Margin changes, leverage, funding stress, collateral needs, dollar strength positioning, exchange rule shifts, and none of those things ask the simple childlike question retail investors love to ask, which is, shouldn't T-gold go up if the world is dangerous? Number not upstairs. Upstairs, the paper market does not reward you for being philosophically right. It rewards you for surviving the mechanics. That is a very different game. I have spent too much of my life around markets to confuse price discovery with moral discovery. Markets do not exist to make intuitive stories come true. They exist to clear orders, crush weak structures, and discover who can meet the next demand for collateral. If the world gets more dangerous and the people long paper gold cannot meet the next margin call, they will sell. They will not pause to defend the poetry of gold. They will sell what can be sold. That is what paper does. It creates a ceiling over the metal itself, a whole upper structure of derivatives, claims, narratives, and leverage through which the visible price must pass before the physical reality underneath can fully assert itself. Sometimes the ceiling is quiet, sometimes it becomes the whole story for a season. This was one of those seasons. The second floor is what I call the margin elevator. Now we get to the move that changed the mood of the whole building. The source material argues that the CME changed the way gold futures margin was being calculated and then raised requirements again and again over a short stretch. Whether one describes the exact formula in one technical phrase or another, the practical result is what matters. Carrying long gold positions suddenly became more expensive, right? As volatility was rising and right as the underlying dollar and rate environment was already turning harder for the paper longs. Fe turn 64 file 0 Fe, that is the margin elevator. An elevator does not ask whether you feel like going down. It moves because the mechanism has been engaged. The beauty of this metaphor is that it explains why so many people are confused by commodity crashes. They think the crowd changed its mind. Often the crowd never had the privilege of a full thought. A rule changed. The carrying burden rose. The weak hands could not post, so the elevator moved down. And because gold was already near record highs before the flush, the move had something extra attached to it. A percentage, based, or otherwise more volatility. Sensitive margin structure means that as the gold price rises, the capital burden attached to the contract can also climb. That creates a built-in amplifier. The stronger the move had been, the more vulnerable late leverage buyers could become once the exchange turned the screw. That is exactly the sort of mechanical asymmetry the source material is trying to pull into the light. Fay file site Fay turn 64 file 0 Fay. This is why I tell ordinary people never to romanticize leverage. Leverage is not simply more exposure. It is exposure with a trapdoor under it. When the rules or the funding conditions change, you are not negotiating with the market. You are obeying it. If you held physical metal with no leverage, the elevator could not force you to do anything. If you held paper gold financed through fragility, the elevator was the market. That distinction matters more than most people realize. The third floor is what I call the dollar stairwell. The source material is correct to explain that this gold flush did not happen in an empty room. The dollar strengthened sharply as war risk rose, as oil surged, and as the United States still looked like the deepest immediate liquidity pool in the world. Fay file site Fay turn 64 file 0 Fay, that is the dollar stairwell. You do not have to like the dollar empire to understand what it does in moments of stress. When the world gets frightened, money climbs toward the highest, widest, most familiar stairwell. The dollar remains that stairwell for a very large part of the world. And because gold is priced globally in dollars, a stronger dollar is not a side issue, it is pressure. The same ounce of gold becomes more expensive in weaker currencies. International demand at the margin becomes more difficult. Dollar assets become more attractive. U.S. government paper still carries the stamp of immediate liquidity for large institutions. Suddenly, the crisis that many thought would obviously be good for gold becomes, at least in the near term, a competition between two kinds of refuge. That is what most people are not trained to see. They were taught one childish rule: crisis equals gold up, number sometimes crisis equals dollar first, gold later, sometimes crisis equals collateral demand first, metal accumulation later, sometimes crisis equals a split between the fast market and the slow market. That is why adulthood matters in investing. Adults can hold more than one cause in their heads at once. Children need slogans, markets punish children, the source material lays out the chain in the right direction, war raises oil, oil lifts inflation anxiety, higher inflation makes the Fed less able or less willing to rush into lower rates. For longer rate expectations support the dollar and treasury yields. The stronger dollar and the heavier yield backdrop clamp the paper gold market. Fay file site Fay turn 64 file 0 Fay. That is not a contradiction to the long-run case for hard assets. It is just the dollar stairwell doing what it always does in stress. The fourth floor is what I call the emergency window. This is where gold stops being ideology and becomes liquidity. One of the strongest parts of the source material is its discussion of who had to sell Turkey defending the lira and absorbing higher energy import stress, Gulf states raising cash to navigate war pressure and stabilize their positions, funds and leverage players meeting collateral demands. The exact tonnage figures can always be argued over in the weeds. The structural point is what matters in a geopolitical liquidity shock. Some of the first people to sell gold are not always people who stopped believing in gold. They are people who need dollars now more than they need metal this week. Fay file site Fay turn 64 file 0 Fay, that is the emergency window. A window exists to get out. It does not ask whether the building still has long-term value. It just offers an exit. This is where many investors become stupidly moral. They say, if they sold gold, then gold must be weak. That is nonsense. A country defending its currency can sell a reserve asset and still regard that reserve asset as important. A fund hit by margin calls can liquidate something it likes in order to survive another day. A state facing war costs can tap the most liquid high value asset it has without changing its philosophical view of the asset. This is one reason I hate reading too much metaphysics into forced selling. An emergency sale does not tell you the truth of an asset over 10 years. It tells you who needed the window, that is all. And if you can keep that distinction clear in your mind, you will make much fewer stupid conclusions from short-term moves in anything. Not only gold, the fifth floor is what I call the French corridor. Now we step away from price and look at custody. This is where the story becomes much more interesting than a simple market flush. The source material emphasizes that France removed or replaced the last of its gold that had been sitting in New York and ended up with 100% of its national gold position effectively under Paris control. It also points to renewed German debate about whether a meaningful portion of Germany's gold should remain in New York at all. Fe 64 file 0 Fe. Now, I do not need every colorful speculation in the source document to be literally true in order to respect the signal. The signal is the corridor. A corridor is the place between trust and direct control. As long as trust is strong, countries tolerate distance, their gold can sit abroad, their reserves can live inside somebody else's fortress. Efficiency outruns emotion. Standards and convenience and historical arrangements are enough to preserve comfort. But when trust starts thinning, the corridor changes. The question stops being, is the gold there on paper? The question becomes, whose floor is it actually sitting on? That is the French corridor, and I think the source material is right to treat it as one of the most important gold stories of the period. Because this is no longer about retail enthusiasm or chart patterns. This is about sovereign custody behavior. When one of the largest holders in the world prefers direct or localized control over metal rather than distant confidence, that tells you the vault floor is having a very different conversation from the trading floor. The trading floor argues about price. The vault floor argues about possession. Those are not the same debate. The sixth floor is what I call the delivery shaft. This is the part where paper and physical begin visibly diverging. The source material says deliveries hit records and registered inventories available for immediate COMEX delivery dropped sharply again. The exact daily numbers will move, but the structural message is what matters. The physical layer of the market was not behaving the way the collapsing paper narrative suggested it should. Metal was being pulled. Inventory available for immediate delivery was thinning. Fe 64 file 0 Fe, that is the delivery shaft. The shaft moves things between floors. And when you see a lot of activity in the shaft while the theater upstairs is screaming weakness, you should at least consider the possibility that the lower floors are using the upstairs panic to move inventory into tighter hands. This is why I always tell people not to confuse a lower price with lower desire. Sometimes a lower price is simply the mechanism through which stronger buyers get better terms. A fast market flush can be a physical market gift. That does not mean the move is fake. It means the move is doing two jobs at once. Upstairs, it is punishing leverage. Downstairs, it is enabling transfer. That is a very different way to read what happened. And it matters because the long-term owner does not really care whether the theater crowd was humiliated this month. He cares whether the metal is migrating into hands that are less price sensitive and more trust sensitive. That is what the shaft helps reveal. The seventh floor is what I call the Eastern Hall. This is where the source material becomes strongest in its institutional analysis. It describes UBS coming back from China with a clear message from institutional conversations. The bias over the medium to longer term remained decisively positive on gold. It highlights resilient Chinese ETF flows, stronger Shanghai trading activity, and perhaps most importantly, the regulatory opening that allows major Chinese insurers to place part of their enormous asset base into gold. Fe 64 file 0 Fe, that is the Eastern Hall. And it matters because insurance money is not hot money. Insurance money is ballast. It does not show up because a chart on social media looked exciting. It arrives because an institution has decided that gold belongs inside its risk architecture. That is a very different buyer. This is one of the reasons I do not care very much when retail people mock gold after a paper flush. I am not investing against retail mockery. I am paying attention to where the largest, slowest, most structurally important pools of capital are being given permission to move. If Chinese insurers begin allocating, if central banks keep buying, if sovereign custody concerns deepen, if Western paper traders keep getting flushed while Eastern or sovereign hands keep accumulating, then the direction of the building matters more than the noise of one bad quarter. The source material is right to frame this as a big story, because once large insurance balance sheets and reserve managers decide the metal belongs in the structure, the demand base changes. The upstairs floor can still panic. The downstairs floor becomes heavier. That is what serious investors should be paying attention to. The eighth floor is what I call the central bank basement. This is beneath even the vault floor. The source material reminds viewers that central banks have continued buying gold at a historically strong pace and that the countries doing so are not random. Poland, Kazakhstan, Brazil, China, and others are acting from a reserve management logic, not from internet tribalism. Fe 64 file 0 Fe, that is the central bank basement. Why a basement? Because it is the deepest foundation of the whole building. Retail tells stories, funds make trades, sovereigns rearrange foundations. Gold, at that level, is not a meme or even a speculative asset class. It is a reserve vote against over-reliance on someone else's paper order. It is a way of saying quietly that when trust gets thinner, some assets matter because they are outside somebody else's liability stack. That is why central bank behavior matters more than commentary. It tells you what serious actors want beneath all the official speeches about cooperation. reserve diversity, financial stability, and confidence in the existing order. I always ask one question in moments like this. What are the slowest, heaviest hands doing? The basement answers that question. The 9th floor is what I call the Safe-Haven Misread. Now I want to clean up the intellectual mess this whole episode creates for average investors. Gold is called a safe haven, then it falls during war, so people conclude one of two stupid things. Either safe haven is a lie or gold is a scam. Both reactions are childish. The better conclusion is that safe haven is a role, not a timetable. The source material circles around this without saying it in exactly that way. Gold can be strategically important and still get hit in the short term. If the paper market is being forced, the dollar is rising, and stressed actors need cash immediately. Fe 64 file 0 Fe, that is the Safe-Haven Misread. A safe haven is not a magic elevator that rises every time danger appears. A safe haven can be smashed in the upper floors and still quietly desired in the lower ones. A safe haven can protect purchasing power over a cycle and still terrify weak hands over a month. This is why the path matters. You can be long-term correct and still get destroyed if you chose the wrong instrument, the wrong leverage, or the wrong time horizon. The public hates this truth because it ruins slogans. I am happy to ruin slogans. Slogans are expensive. The 10th and final floor is what I call the vault test. This is what I would actually do with the lesson. The source material ends by saying the smart move is to watch actions, not words, to distinguish paper from physical, to observe institutional behavior, and to think in cycles rather than headlines. That is directionally right. Fe file site Fe 64 file 0 Fe. I would simplify it even more. First, know which floor you are on. If you are trading futures, leveraged ETFs, or short horizon paper exposure, then you are on the trading floor and you must respect the elevator, the stairwell, and the theater. You are not holding gold in the same way a central bank is holding gold. Second, if you are building long horizon protection, think like a vault owner, not a chart tourist. Custody matters, counterparty structure matters. The distinction between convenience and possession matters. Third, do not expect the upstairs floor to validate the downstairs thesis on your emotional schedule. That is one of the biggest mistakes long horizon investors make. They hold a 10-year thesis in a 2-week nervous system. Fourth, watch custody behavior and institutional permission structures more than you watch internet emotion. Fifth, remember that a paper flush can be a vault opportunity. That is the test. Not do I like gold, but do I understand which market I am actually in and what forces control it? That is the adult question. Now, let me end where I began, with the building. Gold did not give you one answer during this crisis. It gave you two upstairs. The answer was force, leverage, dollar pressure, and liquidations. Downstairs, the answer was custody, mistrust, institutional accumulation, and physical movement. The public keeps asking the upstairs question, why did the price fall? The more serious hands are asking the downstairs question, where is the metal going? I know which question interests me more because prices can be bullied for a season. Custody tells you what the world is quietly preparing for, and if you understand that, then the crash you just watched stops looking like a contradiction. It starts looking like a building telling the truth floor by floor. That is what I would remember. Every time the theater gets loud,